10% of 137,000. And then when come to year 2, because he has paid 16,000 to 16, so hang on. 42,700. Can you deduct? Can you plus another 6% here? 16%. So that means
16.
Yes. 16 to 6. 16 to 16. Hang on, I also forgot already. I have to check my Excel.
Okay.
It takes time if we check that, because I'm worried about the tutorial. Now, can we come back later?
No problem, no problem.
Okay, we come back later. We just go to a very simple question first.
All right, no problem.
Okay, any other question? No? If not, then we go straight to our tutorial for today. Would you like to ask any more question, or we go to tutorial?
No question from me.
No question. Okay, we go to our tutorial today. Let me record the meeting first. Okay, so we go to let me share the screen. I think this one, right?
Yes.
Okay. Anyone got the answer for this? Who want to answer?
Doctor, I will try.
Okay, give the framework first.
Sorry?
Framework.
Oh, framework. So the question wants us to discuss about the main characteristics. So the first thing I will discuss about the dual banking system in Malaysia, which consists of conventional and Islamic. And then after that, I will talk about some of their similarities for both conventional and Islamic. After that, continue to the difference between these two systems.
Okay, so this question is rather a straightforward question. So that I can accept that kind of framework. Is that now?
Yeah. So can you stop presenting?
Wait a minute. Yeah, sorry.
Can you guys see my screen? Okay. Okay. So this is my framework.
I can't hear. Hear my...
Sorry? Doctor, I can't hear you clearly.
还是你关麦去好电脑？
Doctor, can you hear me? I think we're losing you already because the no connection. Doctor, can you hear us?
Got echo, not that clear.
How,
On and off.
hold on.
Doctor, can you hear me?
Yes, me, I can hear you.
Okay, then I'll continue. Okay, so this is my framework. Like I say, first thing I will describe about the dual banking system, which consists of the conventional and Islamic, and then the similarities and difference. I should go to my answers. So like in Malaysia, we apply dual banking system, which consists of the conventional finance and Islamic finance. And then both of these banking system will move in parallel to create healthy competition, which means that they're almost similar in terms of offering in terms of the rate they offer to the customers. And then and then I move on to the conventional finance. Conventional finance is a finance that the transaction is based on interest rate for the borrower to obtain funds from the financial institution. And most of the conventional finance are offered by the conventional bank, such as Maybank, Public Bank, or CIMB Bank, this one. And then Islamic finance is a type of financing activity that must comply Sharia law. And Islamic finance is offered by Islamic bank. And then both of the conventional and Islamic finance in Malaysia is aimed to provide funds to the purchaser in order to obtain home ownership. And then other than that, both of these finance also provide funds in terms of bridging finance for the developers to carry out development. And then regardless of which type of finance is obtained, the buyer will repay the payment in different basis for a certain period of time. And another similarities of these two finance system is that there is no restriction for the public to obtain financial support from both of these both types of finance. Everyone can apply. There is no restriction that like only Muslim can apply for Islamic finance. Everyone can apply conventional or Islamic. It's open for everyone. And this is the difference between conventional and Islamic finance.
Hang on. Let go. Minyo.
Yes.
Okay. Okay, for this step, make a correction first. When we talk
Okay.
about conventional, it's really called conventional loan.
Doctor, I can't hear you
And
clearly.
But we have to make or use the correct terminology first.
Okay, sure.
Okay?
Okay.
For Islamic, we usually call Islamic finance. For
Okay.
conventional, usually we call conventional loan.
Conventional loan.
Okay? We call conventional loan, but we cannot call Islamic loan.
Okay, noted.
Okay, that's the terminology. And then you said just now there is no restriction. I didn't get what you mean. What's that? Say again.
The no restriction one. Is it?
What do you mean?
Like for both Islamic and conventional finance, they are all open to public. It's not like for Islamic, only Muslim can apply. Other non-Muslim also can apply for Islamic finance. That's what I meant.
Okay. But it's not a good idea to use we restrict one particular thing to happen. So just say that it's open to everyone.
Okay.
If you use knowledge system, but it seems like some things are not that accurate to use in this case.
Okay, sure.
Okay. Nothing wrong, but it's not a good to use. because when you use another system, something that is very heavy. Like for example, you cannot go overseas because of the restriction due to COVID-19, for example. So you can use that particular word, amortization.
Okay, sure.
And then both type of finance offer products in PMM and CM.
Yeah.
What do you mean?
Yeah, this is- Okay, so like the financial product of Islamic finance and conventional loan are available in primary mortgage market, which is open to public, and then also in CM. In CM for Islamic finance, it's Sukuk, and then for primary mortgage is mortgage-backed securities and mortgage bond. Both of them have product in both other two markets. That's what I meant.
I can hear you properly. I don't know, maybe because of
Okay, so I
my
Doctor, can you hear me?
I
Doctor,
can hear,
you
but
hear?
on
Doctor,
yes,
I think
now I can.
now can. So I will re-explain about the both type of finance offer products in PMM and CM parts. Okay, so based on my understanding that both of the finance got products in primary mortgage market and also capital market. So like they offer products in both market. It's not like Islamic finance only have product in PMM, but CM we don't have. That's my understanding. Hello, doctor, can you hear me?
Doctor, can you hear us?
Can you hear me now?
Just now we are losing you. Doctor, did you hear me just now? Hello, doctor, can you hear me? Doctor, can you hear me?
Yes, yes.
Did you caught just now what I say?
No, not at all.
Okay, never mind. I'll repeat again. So like based on my understanding, for me like for conventional loan and Islamic finance, both offer product in the primary mortgage market and capital market. It's not like the Islamic finance only provide product in got product in primary mortgage market but doesn't have securities in CM capital market. That is what I meant actually. You started. Hello, doctor, are you here? Hello, doctor, did you hear me? Hello, doctor, did you hear me?
Yes, now I can hear. I don't know what's going on. Your screen also become very, very.
What? Sorry, doctor, I can't hear you clearly.
Your screen.
My,
Oh my God.
but I think it's normal when I look at others people laptop. Doctor, can you see my
I cannot see your screen.
Connection problem.
Doctor, I think maybe you have some connection problem. Can others see my Microsoft Word?
Yes.
Can.
That's no problem. Ayun.
Mine is good.
I try to present again.
You screen.
Doctor, can you see it now?
Can you sharing the screen and reshare again?
Oh, for the both type of finance product offer in PMM and CM. Doctor, are you here?
But I think we have a problem with your connection also because that suddenly gone, suddenly have. I think your
I
internet.
don't know. My internet is stable.
Huh?
My internet is
Because-
stable. So I don't
Because
know.
doctor, we can hear Minya, but then we keep losing it.
Yeah, we keep losing you actually.
Yeah, but I have full. I have full connection. All the bars are there. That means I shouldn't have any problem with the internet. But I'm not sure what's going on.
Doctor, actually we hear you, during this this tutorial we hear you most of the time at a machine sound.
Sorry?
We can't hear you clearly.
Uh, I don't know.
So we can't hear you.
Everyone, Merry Christmas!
You ni.
Merry Christmas.
Pening ah ni.
Hello everyone, can you hear me again?
Yeah.
Can.
Okay. Sorry, I don't know what's going on because it has been okay since 9 o'clock this morning. You know, I had class up from the morning and then a meeting in the afternoon, but it was okay. But now we are back to normal again after I get out from the screen just now. Okay, so I think Minjao, can you share the screen again?
Can others see my
Okay.
screen? Okay.
Yes.
Okay, so which part should I continue?
The same part, both type of finance offered product.
Oh,
I don't
okay,
understand
so
what you mean.
based on my understanding, this is my understanding. For both conventional loan and Islamic finance, both have product in the primary mortgage market and the capital market as well. It's not like if Islamic finance only have products in primary mortgage market but have no product in capital market. That is what I meant actually.
So what do you mean in the capital market?
The securities, Sukuk and mortgage-backed securities and mortgage bond.
Okay. You have to make it clear there.
Okay.
And then
Difference. So I make a table to show the difference. First thing for the first difference is for conventional loan. It doesn't, it's non-Sharia compliance, whereas for Islamic finance, it must comply the Sharia law. Anything prohibited in the Sharia cannot be cannot apply for Islamic finance. Okay. And then for conventional loan, the biggest and the Islamic finance, the biggest difference is the interest. For conventional loan, it has involvement of interest, and the interest will fluctuate from time to time, depends on the economic condition. And for Islamic finance, it's prohibited from taking interest, but instead of interest, they use profit. And the profit is predetermined and is fixed throughout the maturity of the housing finance. And then the third one is the relationship of the financial institution and the buyers, creditor and debtors. So the buyer is like they own the financial institution, the loan, and they need to repay back. As for Islamic finance, they are mostly based on joint ownership concept, which both financial institution and the borrower are like co-proprietor of the properties. Okay, that's what I think. And then in terms of the repayment, for conventional loan, it will have more flexibility since the repayment also based on the interest rate, which is fluctuate from time to time. When interest rate is low, the repayment will be low. In this case, it will be easier for the borrower to refinance. As for the Islamic finance, the repayment for the monthly repayment for the Islamic finance is fixed, which means that they also hard for them to refinance, but actually easier for them to plan for the budget because the repayment is fixed. And then transaction. For conventional loan, there is no requirement for valid transaction to occur in order to obtain financial support. As for Islamic, it must have the valid transaction. Okay, this I think is for the loan for borrowing just for money without any conventional product. And then the risk for conventional loan, the risk is not equally distributed and is placed on the borrower. As for the Islamic finance, the risk and is same as the profit is shared between both parties, and the ratio of sharing risk and profit are predetermined. As for conventional loan, just like I mentioned just now, got and Islamic finance as well, got product in the capital market. The securities product from the conventional loan are known as mortgage-backed securities or mortgage bond. As for Islamic finance, it's known as sukuk. And that's all for my answer for this tutorial.
Okay, so any comment from the floor, from the class?
No.
Basically the best.
Okay, if not, then I would like to ask you a question. League one, because you said no first. I would like to ask you a question. Okay, so in conventional finance, we have learned that we have fixed rate mortgage and variable rate mortgage, correct or not?
Yeah, during lecture 8.
Okay. And then for Islamic finance, we learn about Islamic finance, which is fixed in terms of repayment, correct or not?
Yes.
The only difference is the conventional we use interest rate, the Islamic finance we use profit rate. Is it correct?
Yes.
Okay, now I would like to ask you a question. Both are fixed. For conventional under fixed rate mortgage, that means we fix, we pay a constant payment in terms of, if we talk in terms of constant payment mortgage. So that means every month we are paying the fixed payment, correct or not? And then for Islamic finance, we also paid the fixed monthly payment, correct or not? So what's the difference between the two in terms of monthly payment? Is there any difference?
The amortization amount.
But both are the same, right?
Yeah. Hold on.
My question is, what does it mean, or what's the difference between the fixed payment under conventional and the fixed payment under Islamic?
One is the Murashaba Mufabika. I forgot the terminology. One is like the joint ownership one. So the differences is like
No, I'm not talking about the co-ownership. That's the principle. But I'm talking about if you pay 2,000 in conventional system, and you also pay 2,000 under Islamic finance, is there any difference between the two fixed payment?
hold on, doctor. The yearly redemption will be different because the CPM constant payment mortgage, although the annual payment per month or maybe annually is still the same, this is applied to Islamic finance as well. But when you look deeper into the
Wait. For that's charge 6% interest. Okay. And then for Islamic finance, we charge 6% profit. Although in actual fact it's not the same, but because we want to compare. So 6% for commercial finance and 6% for profit rate under Islamic. And then on monthly basis, we are paying 2,000 per month for conventional as well as for Islamic finance. So actually, what is the two fixed payment?
Sorry, Doctor, I lost you just now, the last sentence.
What is the difference between the two fixed payment?
Or between the two fixed payment.
Hmm.
In terms of the profit, in terms of the interest, total interest charge will be greatly different. Because Islamic finance is based on the profit sharing, which is a pre-agreed determined. So, but the conventional loan, the interest is charged based on the outstanding principal, which means at a very early beginning, early stage, about 1 to 15 years, most of the time the buyer will pay more interest compared to paying the loan amortization. But in terms of Islamic finance, actually the home buyer, those borrow loan from Islamic finance, they're paying the interest and then the same capital repayment every year. The ratio, the breakdown of interest, the main difference is to me is the breakdown of the capital and as well as the interest charge per month. Is it total what you mean? Tujuh. Doctor, can you hear me? Doctor? No, are you
Can you
there?
hear me now?
Yes.
Uh,
Now.
now I know the trick. If it's happen like that, I have to get out of the system and then re-enter again.
Then, Doctor, did you catch what I say just now? Or I have to, I repeat again?
Repeat again. Not at all.
Okay. To me, the main differences is the composition of the interest as well as the capital charge. So okay, let's talk about the conventional loan first. The conventional loans, because the interest is charged based on the outstanding principal annual. So at the early stage, upon 1 year, first year to 15 year, the interest rate charged for the conventional loan will be high, which means the composition of interest paid compared to the loan amortization is very high compared to the capital repayment at a early step. This one is for the conventional loan. But when we talk about the Islamic finance, because the profit has been predetermined, which is already pre-agreed during the loan agreement. So during the mortgage agreement, so the yearly interest or yearly profit rates remain the same throughout the mortgage repayment period. And then every year, the Islamic finance also charge only the same percent of capital repayment. This is a main difference between the conventional and Islamic finance to me.
Yes, correct. But you did not answer my question. Your answer was correct, but you did not answer my question. All your explanation are correct. Okay?
Okay.
But you still did not answer my question. Can someone else answer?
It does not have any different in terms of repayment for CPM and Islamic finance because the repayment amount is same throughout the mortgage period.
Am I losing you again? Can you hear me?
Yes, we can hear you.
Doctor, your question is say like the main differences between the normal CPM, conventional CPM, as well as the Islamic CPM, right?
No, I'm talking about the fixed repayment, the amounts of fixed repayment. You pay 2,000 under Islamic, you pay 2,000 under conventional.
And no difference at all.
There is a difference. That's why I asked you a question. So how do you differentiate it? Can you point to someone to help you?
Yeah. Doctor, you said ask me to call someone to help me. Oh, okay.
You
Sure.
are the lecturer now.
Huh?
You are the lecturer now.
Oh, okay. Susan.
I cannot really differentiate. What I thought is like Mingyao, no difference because the payment is fixed and the same.
It will be different. Can you call someone, Susan?
Lavinia.
I haven't figured it out.
Just give the hint. Lavia.
Hint.
You do not try to answer. I cannot help you to answer. I want to see how far do you understand.
Because as far as I know, the difference is in the composition, like what Likwan was saying. So I haven't.
So
Yes.
what I mean is here, if you pay 2,000 per month under conventional, and then 2,000 per month under Islamic finance, towards the end, did you actually pay 2,000 ringgit per month for each option? You pay 2,000 per month, definitely, a fixed amount for conventional, and then 2,000 per month for Islamic. Do you really think that 2,000 will actually represent the payment for both options?
No, it's different because in terms of Islamic finance, the profit rate is already pre-agreed. So they are not charged like conventional loan, which they charge based on the outstanding balance sheet. So in the case like Doctor say just now, maybe the profit per month is remain the same throughout the mortgage period. But compared to conventional at the early stage, the profits, the composition of profits, composition of interest is much more higher compared to Islamic finance. And overall, the Islamic finance, if we get Islamic finance, we pay less interest compared to conventional loan. Is it?
You cannot say less interest. This is because we are doing the comparison, that's why we are using the same rate. And then because we also need to have in a win-win situation, like I always explain. So in terms of interest in actual practice, yes, correct, slightly lower. But sometimes when come to conventional system, when the market is very good, sometimes the interest rate is much lower than the Islamic finance. So what I mean here, you pay 2,000 under Islamic, and your friend pay 2,000 under conventional for the loans of 200,000. Towards the end of the mortgage period, let's say both are 25 years period, will you actually pay the total amounts plus interest? Because logically, we pay the same thing, then towards the end, we should be able to pay the same amounts altogether. Interest plus capital, the other one, capital plus profit. So if 200,000 become 400,000 at the end, so by right, it should become the same thing, right? 400,000, 400,000.
Yes.
Will you get that amount? That's what I mean. If you pay 2,000 and 2,000. Come on, class. Anyone can answer, no right or wrong. I will be happy if you try to answer, even if you give me a wrong answer, rather than to keep quiet.
Sorry, Doctor, can you repeat that last part?
Last part is what? Forgot already.
You said 2000, then
I think Lavinia means the example doctor you give, the friends and me paying the same amount one.
Can you re-explain, big one?
So I try to recall what doctor said. Doctor said that when you and your friends also two have different type of loans. For me, like maybe I'm taking conventional loan and you taking Islamic finance. So we both have the same interest rate, same capital, and same mortgage term. So that means that we are paying the same repayment monthly. So this part you understand, right? So when we talk in academic purpose, so definitely the results show by both this type of finance system will be the same, but actually there's a different in it. So this is what doctor asked about. So but I'm not sure about the difference lah.
Siapa nak saya belanja tom yum not delicious lah. Belanja something else. Come on, try to answer.
Doctor, is it you for conventional loan, you pay for the sake of the interest, but in Islamic finance, you pay for the sake of rent?
Okay. Make it like this. For Islamic finance, you borrow 200,000, and then it will involve the future value, okay, which is the markup sale. Let's say in 25 years, from 200,000, it will become 800,000. So 600,000 is the difference. You buy now, you borrow now 200,000, and then in year 30, it will become 800,000. So that 100,000 has been determined in advance as a markup sale. That means we know the profit already. The bank will take about 600,000 profit. Clear or not?
I don't actually get.
No, because it involves what we call it predetermined or a markup sale under murabaha. You borrow today 200,000. Forget whether Masyarakat Menurut Tanah Kisah or Tawaruk or BIE Taman Ajil, forget about the names given. But the concept is that you borrow 200,000, then the price has to be marked up to future value, which depends on the banks. So the example I'm giving here, let's say in 30 years, the bank's markup value is 100,000. That means you borrow 200,000 now, so you have to akad, to say that you agree to purchase this not at 200,000, but at 800,000 on deferred payment basis. Can you see what I mean?
Okay.
Okay, so you borrow 200,000, but you agree to pay 800,000 throughout the mortgage period in 30 years. That means 800,000 is under the agreement between you and the financial institution. So no up or down. That means 800,000 is the amounts that you have to pay on the assumption that you do not pay the property or you do not refinance the property in between. So not even a single cent less than 800,000 or a single cent more than 800,000 because you agree to pay up to 30 years period for 800,000. You see what I mean?
Okay.
Okay. Under conventional system, you are also paying 2,000 ringgit per month. Okay. So the payment is fixed. The payment is fixed. But when come to certain circumstances, let's say the economy is not that good, you are still paying 2,000 ringgit per month. If during economic boom, you also pay 2,000 ringgit per month, the same like Islamic finance just now. But the fixed here, that's why we have variable rate mortgage or price level adjustable mortgage. Okay. And then we have constant payment mortgage, constant amortization mortgage, and graduated payment mortgage. So, the amounts, the fund that we borrow from financial institution. So by the end of 30, it should be 800,000 as well. Clear or not? 800,000 and 800,000. But in actual situation, it wouldn't be like that. Under conventional system, that 2,000 is fixed, but the actual figure that you are paying for the capital outstandings and the interest will differ. Although you are paying 2,000 per month, but inside that 2,000 it will differ. That means the actual outstanding capital won't be exactly the same like we have seen under constant payment mortgage. Let's say at the moment, the bank charges you 6%. And if, let's say in 3 years' time, the interest rate increase to, let's say, more than 6% to 8%, so there will be 2% different. But you still pay 2,000 ringgit per month. So that 2,000 ringgit, because the interest increase by 2%, that means the interest the bank will charge is higher at that time. And then the amount paid for the capital outstanding is lower than you are supposed to pay. You see what I mean or not?
Last sentence, can you repeat one more time? The amount of outstanding principal is lower than what?
Sorry, say again.
Last sentence, can you repeat again? The outstanding principal is lower than.
Okay. Let's say in year 5, you are paying, if the market is still 6%, you are paying 70% for capital outstanding and 20% for interest. You are paying 20% for interest, 80% for 20% for the capital, 80% for the interest. Okay. But if at that time the rate increased to, let's say, 6% in actual market, but the agreement between you and the bank is 6%. So that means you are still paying 2,000 per month. So because the interest increase more than 6%, now you'll become 8%. Of course, the interest we have to pay at that point of time is higher than that we are supposed to pay. Clear or not?
Okay, correct.
Okay. If we pay higher on interest, that means the capital we pay must be lower than 2,000, lower than the actual amounts, because we are still paying 2,000. Unlike variable rate mortgage, it follow the amounts from time to time, you know, if the interest increase to 6%, interest increase to 8%, we pay based on 8%.
Oh, okay.
If the interest reduced to 4%, that means less than 6% offered to us, we pay less. That under variable rate mortgage. But under fixed rate mortgage, fixed constant payment mortgage, you still pay 2,000. But because the interest rate increase, you pay more on the interest, but you pay less on the capital. But the amount you pay is still 2,000 because there is a fixed rate. So if you pay more at any particular point of time, that means your capital outstanding will be deducted less. But if you pay more, then if you pay less, then because the interest rate increase, so basically the capital outstanding will be not that much different. So when come towards the end of the mortgage period, so if you look at constant payment mortgage concept, when come to 35 years, both outstanding principal and the amortization should be the same. But during the period before that, if you pay more, than what you are supposed to pay, that means you pay 2,000, but because the interest rate low, so that means you pay more on the capital outstanding. So based on that, your payment towards the end of the mortgage period should be lower. But if the market was not very good, let's say, throughout the mortgage period for 35 years, and then 20 years are not that good, only 10 years is good. So basically, you have more outstanding principal at the end. Okay. So we cannot show that under fixed rate mortgage, under constant payment mortgage. So that's why I show you the concept of constant payment mortgage. It's like that, on the assumption that the 6% will continue until 35 years. Because the purpose is to tell you that we are paying 2,000 per month. We are paying 2,000 per month. No matter what happened to the market, we still pay 2,000 per month, but the capital outstanding differ. In other words, if the market is very good for the whole 30 years, that means we can finish our outstanding principal less than 30 years. You see what I mean? Because we pay more on capital. So instead of 35 years or 30 years, now it may become only 20 years. We can finish the outstanding principal already. If the market is better throughout, but the market is not good, instead of 5 years, so now you still have more capital to be paid few years. That's different, but I mean, the 2,000 fixed Islamic system. Okay, I think I already explained in the lecture notes. Maybe it was very fast, that's why you couldn't follow. But for the sake of understanding, we assume that 6% continue to be in a good market. So 6% throughout 35 years period. But Islamic finance, no matter what happened, you pay 2,000. Whether the profit rate increase or decrease, you still pay 2,000 per month because the future price has been determined. The markup sale has been determined in advance. For the conventional system, no markup sale. It's all depend on the interest rate. So the 6% interest rate, if you use the formula of annuity, you will get the total value at the end of the mortgage period. But that will not be the exact amounts like Islamic finance. Islamic finance, 800,000 is fixed 800,000 no matter what happens. But on the conventional system, all those based on the annuity formula you calculate, you'll get 800,000. It doesn't mean that 800,000 because depends on the interest rate. Although you pay fixed amount of 2,000 per month. You see now, I cannot show you with calculation. I cannot show you with calculation because it differs. So the same like variable rate mortgage. So we have to understand the theory only.
Faham.
Faham?
Faham. Yeah.
Okay, good.
So, doctor, you mean like in CPM, if I'm taking the CPM in real case lah, so if the interest differ over time, so that means my outstanding principal, even though I finish my payment at the mortgage period, there will be maybe outstanding or maybe I surplus lah on the payment of the outstanding principal.
Yes. Maybe surplus, maybe outstanding. Maybe exactly the same.
I see. Okay.
But usually a little different.
Okay.
You know why? You know why? Because normally people do not wait until 35 years. They tend to sell when come to year 10 or year 15, you know, to buy better house. That's why they cannot see the difference. But the bank will calculate up to that stage. Okay.
Okay.
So, Min Yao, your answer just now, one thing you forget about the markup sale, the price. Have you mentioned anywhere?
No.
So markup sale, Islamic finance involve markup sale. That means the price that has been determined in advance, but conventional system will depends on the interest rate offered at the end of, the total amount to be paid at the end of the mortgage period. Okay, so got more answer after this table? Yeah?
No.
Finish already?
Yes.
Okay, and then from the class, is there anything you would like to comment, to add? Anything?
Maksudnya yang konvensional ni is not predetermined lah, kan?
No, conventional is not predetermined. It's depend on the interest rate.
Yeah, I mean it's not predetermined lah. Like Islam conventional is not predetermined, Islamic is predetermined.
I'm not sure whether we use the correct word or not, predetermined, because predetermined usually involves interest rate and profit.
Okay.
But when we talk in terms of value, I don't think that is the correct word to use, predetermined, but we can use under Islamic finance, it involves markup sale. But under conventional system, involve interest to value the profit. So profit for conventional is basically the price of the markup sale and the actual value that we borrow from the financial institution. And then for conventional, the final figure, which is based on the interest as compared to the actual amount we borrow from the financial institution. Everyone?
Faham?
Okay, markup sale rather than predetermined. Predetermined, you can use when you want to talk about the interest rate, predetermined interest rate, predetermined profit. So that word you can use, predetermined. So two different meaning, predetermined and markup. Okay. Okay, any more question on this? Or you want me to ask you a different question? Difficult one? Who want to answer my other question? Because you don't want to ask. Can you raise your hand, please? Nobody raise your hand. Okay, never mind. Never mind. We go to the next question because you don't have any question. So we go to the next one because you know we only have 40 minutes left for the second question. Can someone answer the second question? I'll try to share the screen. What we are supposed to see. I think she's about the basis of mortgage product. Is that correct?
Yeah.
Yes.
Okay. So you also have the question. I don't think I have to share the screen with you. So number one is the basis of mortgage products, and number two is do you select the MRTA and MLTA. So can someone answer this question? I want someone else. I don't want Minya. I want Lee Guan. I don't want MK. You have already involved. I want someone else.
Can I try?
Okay.
Can I try?
The screen. Yes, sure.
All right. So basically, wait. Can you see my screen?
Yeah.
All right.
I can hear your voice.
So first of all, the framework is to define the mortgage, and then to explain the mortgage product that available in the mortgage market, which is basis of fixed rate mortgage, amortized loans, adjustable rate mortgage, variable rate mortgage, and basis of variable rate mortgage. Yeah, that's for first question. So yeah, we start with definition of the mortgage first.
Okay.
Well, mortgage is a debt instrument secured by collateral of specified real estate property that the borrower is obliged to pay back with a predetermined set of payment. So this panjang sangat, so I boleh dengar tak?
Boleh.
Boleh. So this is the definition of mortgage, and then we jump into the basis of fixed rate mortgage, which is that carry the same interest rate throughout the entire length of the loan. The most mortgage who purchase a home for the long term end up locking in an interest rate with a fixed mortgage. which is they prefer this mortgage product because more predictable and the borrowers know how much they will expect to pay each month. So there are no surprises because it is fixed rate mortgage. But for amortized loan, also the most common type of mortgage, this loan have fixed rate of interest over the life of the loan and steady installment payment. A fixed rate amortizing mortgage loan requires a basis amortization schedule to be generated by lender. This is because the interest rate in a fixed rate mortgage doesn't change for every installment payment. Because the amortized loan is basically fixed, the amortized value. And then the next is adjustable rate of mortgage. It requires a fixed rate of interest in the first few years of the loan, followed by variable rate interest after that.
Just to confirm, you'd like to call you Amalia. Who would you like to?
And for variable rate mortgage, it is a type of home loan which the interest rate is not fixed. Instead, interest payment will be adjusted at a level above a specific benchmark or reference rate. It means the mortgage is not fixed lah. So the basis is lenders offer both variable rate and adjustable rate mortgage loan product which differ variable rate structure. Generally, the mortgagee can offer borrowers either fully amortizing or non-amortizing loan that incorporate different variable rate interest structure. Borrowers actually can take advantage of decreasing rate without refinancing since their interest rate decrease with the market rate. So it's the advantage for the borrowers lah. In full-term variable rate loans, we charge borrowers variable rate interest throughout the entire life of the loan. In a variable rate loan, the borrower interest rate will be based on the index rate and any margin that is required. The interest rate on the loan may fluctuate at any time. Maksudnya interest rate tu may up and down during the life of the loan. Yep, that's for question 1.
Okay, any comment?
I think it's better to list down the 4 products like PAM, CPM, GPM, and PLAM.
Oh,
What's your answer, Ivan?
apa dia?
What's your answer to MK question just now? Suggestion.
Well, maybe can reconsider because that one is week 9, right? This is week 8.
Huh?
So
Doesn't make any difference.
Tak tahu lah. Tak sama je kot.
Now we are in week 10 already.
No, I mean for tutorial of week 8. So basically based on week 8 lecturer lah kan.
So next week we have to cover 2 tutorials. I want Luna to ask or to suggest anything to Ivan. Luna, are you here? Luna?
Yes, Doctor, I'm here.
Say something to Ivan.
I don't know what to comment.
Do you agree with his answer? Luna?
I think can explain more the details.
You think what?
I think can explain more about the details.
explain more about the detail. Iwan, what do you think? You are the lecturer.
The detail. Well, maybe I should explain like include the example. I think, but yeah, that's what I miss.
Okay. Anyone to say something about Iwan answer? Or I'll call you. Which one do you prefer?
Econs, can you move down a bit to the variable mortgage debt? Okay, hold on. I want to ask what is for the second paragraph under the basis of variable rate mortgage. At the end of the first line, it says that either fully amortizing or non-amortizing loans. What does non-amortizing loans mean?
Non-amortizing loans. Well, non-amortizing loans like the amortization is not fixed. Yeah, but macam mana fully amortizing and non-amortizing loans. I cannot explain it like on layman term, but I think that fully amortizing is basically like the example that Dr. said for the previous tutorial. Like the full amortizing is basically after the mortgage period ends, so the loan was fully amortized. But for non-amortizing loans, basically the interest rate is fluctuate, and at the end of the mortgage period, basically still can pay the principal. I think so lah.
Oh, okay, thank you.
So, you have to understand the word amortization. Okay? Amortization refer to the process of repaying the outstanding principal. So towards the end of the mortgage period, the loan will be fully amortized. So that's what it means by amortization. So for the one that, Iwan, can you go up a bit? You have, okay, amortized loan, which is wrong. Why do you call it amortized loan?
Why do I call amortized loan?
Do you get it from me?
Well, amortized loan basically the loan that with fixed interest rate, and the amortized is a steady installment.
No, the name given here. The name given here, did you get it from me?
Come again, Dr.
From somewhere.
Apa dia?
Did you get this name from my lecture or from somewhere else?
Oh, from somewhere else.
There's no such name.
Oh, ya ke?
I mentioned to you now meaning of amortization. Okay. So basically all the loans here, all the mortgages here, the mortgage products here will be fully amortized at the end of the mortgage period. You see what I mean or not?
Yes.
Not only for this particular type of mortgage. This particular type of mortgage is called constant amortization mortgage, not amortized loan.
Oh.
Because when we say constant amortization mortgage, so the amount of outstanding principal will be constant, but not the payment. So if you use amortized loan, you can apply to all the loans that you have. Okay. Nak kena dah ni. Hujan tak sana? Kalau tengah hujan banjir tu, rumah kena banjir tak?
Doktor cakap apa tadi sebab memang sangkut? Ke I seorang je yang sangkut?
Tak, memang sangkut.
Ya, memang sangkut.
Ya, so kat tempat saya tak hujan.
Rumah kena banjir tak sekarang? Hujan banjir Terengganu dengan Kelantan.
Oh tak. tak.
Okay. Semua loans will be amortized. All the loans given here, all the mortgages given here will be amortized by the end of the mortgage period.
Faham?
You cannot amortize loans here. Because amortized loans, it is applicable to all the loans given here. Not only for this particular product. So this product is called constant amortization mortgage.
Doktor, maknanya amortized loan tu sebenarnya nama dia constant amortization
Mortgage.
CPM lah, mortgage. Oh, okay. Faham.
ACM. CAM.
CM.
Not SK. Ini baru betul. Okay. And then you forgot to put graduated payment mortgage. Where is it?
Yeah, I think I forgot about it.
So you have to come up with a graduated payment mortgage as well. But before we go to all the mortgages you have listed here, there must be the main basis or the main concept of a mortgage. What is that? Dia punya kepala ada kat atas before you pergi ke ekor-ekor tu. What is that? Got a question ask you the basis of mortgage. What?
Apa dia?
Is
Doktor sangkut lagi.
Oh, I think kena define mortgage market lah. Macam mana? Hello? Hello?
Dengar. I rasa doktor sudah putus.
Panggil dia lift lagi, masuklah.
Oh, dah leave susah macam ni.
Doktor aku
Hello?
hello, can you hear me again?
Okay, can.
I was having problem again just now.
Oh,
No, where did I stop just now? I forgot already.
Doktor stop dekat yang doktor kata dua main kepala dia tu.
Yes, kepala dia. Yang lain-lain yang jawab ni semua dah ekor dia. Saya nak kepala dia.
Main two types of mortgage doktor nak.
The basis.
Repayment mortgage basis and endowment mortgage basis?
No. For all the mortgages here, they must
Fixed rate dengan variable.
No, listen to me first. All the answer here, the given here are all correct, okay? Except when we talk about discuss, what are we supposed to do?
The pro and cons.
Yes, you must include the pro and con when we say discuss. So you don't have the pro and cons here. No, pro and cons is not supposed to be up there. For each of the mortgage we have discussed here, must have pro and con. Okay? But before you talk about definition of mortgage, at the top there, you must come up with something to constitute the basis of mortgage product. So that means something in common. You are in this class, all of you, regardless of the
Alah, sangkut lagi. You mean to define the mortgage market lah? Or apa? Hello? Hello? Ke left lagi?
Putus lagi.
Oh my god. Ni ada dia.
Sudah freeze ah.
Okay, can you hear me?
Ada pun.
The line is horrible. Okay, what I said just now, there must be something in common. For example, in this class, I say, regardless whether you are wearing a red shirt, or yellow shirt, or black shirt, or you do not wear anything at all, that's why you don't want to show your face, it's up to you, okay? But the main purpose you are here is to learn real estate finance. Correct or not? So when you want to learn real estate finance, that means all of you, whether you wear any shirt or you do not wear anything at all, you have the same focus, which is to learn real estate finance. So this is basically now something in common. Do you follow or not?
Oh, something in common lah for all the mortgage product here.
Yes, that's what I asked you to do. So what is that?
All these products are in the mortgage market to define the mortgage market.
Of course they are in the mortgage market. It will not be in the fish market. Can you find mortgage in the fish market?
Tak.
Tak kena lah ni.
Is
Baik
to
jauh.
is to finance
To finance?
to finance.
Try to find something that all of the mortgages here must have that. Or they must have the same purpose.
The basis of mortgage is principal plus interest or profit incurred.
Yes. So all the mortgages here involve principal plus interest or profit. Type lah laju sikit. Orang tak makan je. Jalan sebelum.
Apa dia?
Jalan sebelum.
Dah.
Makan aja kuat. Kerja lembab. Okay, so that's the first one. And then I always mention in the class, no matter what happened to the market, what is the main priority of the banks that provide the loan or provide the finance?
To get back the capital amount.
Yes, to get back the total loan that have been approved, not even a single cent less or more. If they lend to the purchaser at they lend, let's say the amount of 200,000, they must get back 200,000 no matter what happens. Laju macam tu lah. Jangan tak faham cukup lah, tulis type laju. Itu tak faham. Okay. So that the two basis of mortgage product. Okay, must be there. And then you can elaborate further if anything happen to the loan, let's say due to the default, so what is supposed to do? What the bank is supposed to do in the case of default?
Auction.
Yes. Foreclosure. What is the purpose of foreclosure?
To pay the remaining loan.
Yes, to get back the remaining principal or the outstanding principal. And then if the bank cannot get the full outstanding principal, and then what is the bank supposed to do?
They will give the deficiency judgment.
Yes, deficiency judgment. So that's the first elaboration that you should put before you go to the definition of mortgage. Or you can put definition of mortgage first, but not that long like this. Just put very simple one. What is a mortgage? To just put that like the diagram I given you. Cannot see here. Borrow boleh lah ini pun. Tapi it will the creation of mortgage. You don't have to explain about 15 years, 30 years, etc. under definition. Just go straight to the definition of mortgage, and then go to the basis of mortgage product as the second stage. And then you elaborate all of the mortgage products that we have, not too detailed, because if you go to that detail, you don't have time to answer. And then your answer must have pros and cons. Okay, that's the answer for this question. Can we go to the second part? Who got the answer for the second part? Iwan, you got the answer for the second part?
Orang lain lah.
Kenapa orang lain saya tanya you?
Oh, okay. Teruskanlah.
Ah, pula.
Okay, so for the second part, the question is how the mortgage reducing term assurance, MRTA, and mortgage level term assurance affect the selection of your insurance. So first, for the framework, I will define the MRTA and then elaborate the effect on insurance selection of the MRTA. And then the next part, I will define the MLTA and then the effects on insurance selection. Okay or not?
Your answer is too long because you cut and paste.
Oh yeah.
Okay, on that just now.
This
The
one.
question, do not ask.
Apa dia?
It's too long. The answer is too long.
Oh, the answer is too long. Yeah.
You did not answer the question.
I see. That's why I asked another.
What the question asked you to do? How the two insurance affect the selection, your selection.
So
how do you select the two insurance?
What is like? Apa dia? So I need to do the compare.
Sini.
Huh? Allah, susahnya baca online.
Saya cakap datang sini nak korek telinga sikit.
Datang sana. Oh, tak boleh. Jauh.
Tak dengar telinga.
I dengar, but your apa ni sangkut-sangkut. Kan seorang je yang sangkut?
Saya takut.
Sakit betul lah. Apa ya? Wait, serious. I rasa orang lain kena present this one because doktor memang tak dengar I ataupun I tak dengar everyone.
Kita
Hello?
dengar.
Oh ya ke? I think my problem is
Kita dengar.
my laptop lah.
Hello?
Dengar tak? Hello?
We hear you, Ikwan.
But I can hear doctor.
We also.
Oh, you also.
Abbas.
Apa dia?
Who got the answer for this part?
Oh, orang lain.
Who is JKP Kemas? Who is JKP Kemas? JKP Kemas, who is that?
It's me, Dr. Saliza. Sorry, I used the wrong account.
Tak apa. Boleh you jawab? Second part? Saya tak nak ulang dah tahu nanti. Saya tak nak ulang dah topik ni. Next week we continue with the other two topics. Pasal you are supposed to prepare. Iwan prepare but he cut and paste. Lepas tu telinga dia pun tak correct. So cannot hear properly. Yang lain? Eke. Eke.
Yes, Doctor.
Now, you got answer or not for the second part?
Not really, Doctor.
It's almost
Should I
4
go
o'clock
forward?
now.
Doctor, can I try?
Who is it?
MK.
MK, okay. Quickly try. Because we 4 o'clock already.
Okay. Can you see my screen?
Yes.
Okay. So MRTA is about protecting the borrower only, right? So it covers decrease over time, like we learned in the lecture note, the graph going down every year. So comes with property, can make payment with installment. This means when we purchase our property, we can put in the MRTA with the installment. So less premium because it decrease over time, and it protect actually only borrower, right? So it gives a better interest rate. And then for MLTA, the coverage does not decrease over time. So for example, we buy a property for like 500K, the 500K coverage is along our mortgage period. So has cash value. So we can like do it like saving lah. So because it has cash value, so the premium is higher. So has to buy separately. That means when we buy a property, we have to request with the banker, or you find another insurance agent to buy MLTA separately, and then can transfer to other property. Let's say today I got an MLTA with my property, then I sold it, I buy another property, I can transfer to another property. So so for me MRTA is more suitable for on-stayer, while MLTA is for investor, because MRTA is more less premium. MRTA less premium. So usually on-stayer they want the least cost for their best use of house. So yes, less premium is better, MRTA. And then reduce interest, make them less burden. Okay, less burden on their property. But MLTA, why MLTA is best for investor is because MLTA gives the cash value. Like, because investor, sometimes you need more money for rolling in your investment, especially a full-time investor, property investor. So you need more money to do the rolling. Maybe you want to do extra furnishing for your property, make it good value. So yes, MLTA will be better in this case. Then protect in terms of coverage. Okay, so example today I got a lot of property, then I cover it all with MLTA Once I don't want to say once I die but yes, something happened to the investor, then the MLTA can not only cover all your installment, but also gives the compensation, your extra compensation to your family member to have a good life. Okay, since they are full-time investor, so there's no problem for the money they pay, even though MLTA is more in terms of premium, have to pay more in terms of premium. So that's all from my answer. Doctor?
Doctor,
you sound good again, Doctor.
Yeah.
Hello.
Hello.
We cannot hear you. Hello. It's me. If after all, where doctor has you going?
Aduh, bijak.
And Natana's my old friend.
I'm supposed to heal. Ah, doctor say stop already. End of the class. Everyone, goodbye. Have a good life.
Alright.
Merry